Okay, so you want to own a medical diagnostic lab. Draw blood, run tests, send results to doctors, get paid. Sounds like one of the most stable businesses on earth. People will always need to be tested for something. But here's the strange part. The price you get paid for running that test isn't something you negotiate. It's set almost entirely by the government and a handful of massive insurance companies. And that price has been cut, year after year, for the better part of a decade. Independent labs have watched reimbursement for some of their most common tests fall by up to 30% over just a few years, through a Medicare policy most patients have never heard of. And here's the part that should really give you pause. One diagnostic lab company was once valued at $9 billion, backed by some of the most sophisticated investors in Silicon Valley, run by a founder on the cover of every business magazine in America. It collapsed to zero. Not because the market for diagnostic testing disappeared, that market kept growing the entire time. It collapsed because the company that was supposed to serve it was built on a lie. By the end of this video, you'll know exactly how a diagnostic lab actually gets paid, why that payment keeps shrinking no matter how well you run your business, why even a $9 billion company couldn't survive this industry, and what it actually takes to make real money running one. The three sizes of this business. Diagnostic labs come in roughly three sizes, and they operate under very different rules. The smallest tier is a physician office lab, a small testing setup inside an existing medical practice, limited to simple tests like glucose checks or basic urinalysis under what's called a certificate of waiver. The federal certification fee itself is genuinely cheap, often under $200 a year. The real cost is the equipment and staff time layered onto a practice that already exists, typically $10,000 to $50,000 to get running. The middle tier is a genuine, independent clinical lab, its own facility, its own staff, running moderate complexity testing like full metabolic panels and blood counts for outside physicians. This is where the real investment starts. Realistic startup costs run from around $150,000 to $500,000 once you include lab information system software, testing equipment, facility build-out, and enough working capital to survive the months it takes insurance reimbursement to actually start flowing in. The top tier is high complexity, specialized testing, genetic analysis, advanced molecular diagnostics, reference lab work that smaller labs send out to you. This tier can run into the millions, and it's dominated almost entirely by a small number of national players like LabCorp and Quest Diagnostics, companies that process hundreds of millions of tests a year and can spread the cost of expensive equipment across a volume no independent lab could ever match. Here's the detail that catches almost every new lab owner off guard. The government certification itself, the CLIA certificate that legally allows you to test human specimens, is almost an afterthought cost, sometimes just a few $100s depending on your test volume. The real barrier to entry isn't the paperwork. It's convincing insurance companies to actually pay you a workable rate once you're certified. Which brings us to the part of this business that makes it fundamentally different from almost anything else on this channel. Where the money actually comes from, and why it keeps shrinking. In most businesses, you set your own price. In a diagnostic lab, you almost never do. Medicare pays according to something called the Clinical Laboratory Fee Schedule, and private insurers largely follow whatever that schedule says, which means one government formula effectively sets the price for a huge share of your entire revenue. Here's where it gets genuinely unfair. In 2014, Congress passed a law requiring labs to report their private insurance payment rates so Medicare could set fairer prices based on real market data. The first round of data collection captured responses from fewer than 1% of all labs, dominated almost entirely by the handful of giant national labs that could afford the reporting burden. Small independent and hospital labs were barely represented at all. The result? Medicare set its new rates based on the pricing of the biggest, most efficient players in the industry, then applied those same low rates to every lab in the country, regardless of size. Between 2018 and 2020 alone, this produced roughly $4 billion in cuts industry-wide. With some of the most common tests, the basic panels, an independent lab depends on most cut by up to 30% over that period. And it hasn't stopped. Further cuts of up to 15% per year have been proposed and delayed multiple times since, most recently pushed back again into 2027 after intense lobbying from the industry. Every single year, independent lab owners have had to watch Washington decide, essentially by legislative accident, how much of their core product they're allowed to charge for. This is the part that breaks people's brains the same way a rigged casino game breaks a gambler's brain. You can't offset a reimbursement cut by raising your price, because your price isn't yours to raise. Medicare and most private insurers pay what the fee schedule says, full stop. The only levers a lab actually controls are volume, running more tests to make up for a lower price per test, and cost, squeezing efficiency out of equipment and staffing. Both of those levers favor scale, which is exactly why the handful of national labs keep getting bigger while small independent labs keep closing. Why even a $9 billion company couldn't survive this industry. You'd think that with enough money and enough talent, someone could build a diagnostic lab company that sidesteps all of this. One company tried, and it's the most infamous case study in the entire industry. Founded in 2003 by a 19-year-old Stanford dropout, Theranos promised to replace the standard blood draw with a painless finger prick test that could run hundreds of diagnostic tests from just a few drops of blood. The pitch was irresistible. Cheaper, faster, less invasive testing that could genuinely reshape the entire industry. Investors believed it completely. The company raised more than $700 million from some of the wealthiest families and most sophisticated venture funds in the country, reaching a peak valuation of $9 billion in 2014. The technology never actually worked. Of the more than 200 tests Theranos claimed to run on its proprietary device, only about a dozen ever functioned at all, and even those produced unreliable results. For the rest, the company secretly ran samples on conventional machines from established manufacturers, hidden behind walls in a room employees nicknamed Normandy, while telling investors, regulators, and patients that its own revolutionary technology was doing the work. When Wall Street Journal reporting and regulatory scrutiny finally exposed the gap between the pitch and the reality, the company collapsed entirely. By 2018, Theranos dissolved, its $9 billion valuation gone, its founder later convicted on federal fraud charges. The lesson here isn't really about fraud, even though that's what ended Theranos specifically. It's about what the fraud was covering up. This industry's underlying economics are hard enough that even a company willing to lie to nearly every stakeholder it had still couldn't make the real version of its business work at the scale it promised. The market for diagnostic testing didn't fail Theranos. Reality did. How smaller labs actually lose this money. Away from headline fraud cases, 3 ordinary patterns explain most independent lab failures. Pattern 1. Underestimating the cash flow gap between running a test and getting paid for it. Insurance claims can take 60 to 90 days or longer to actually pay out, and denials are common enough that labs need dedicated billing staff just to keep collections moving. A new lab that budgets for equipment and rent, but not for months of unpaid receivables, can run out of cash while sitting on a stack of legitimate, eventually payable claims. Pattern 2. Overexposure to a shrinking reimbursement category. Labs that built their entire business around a handful of high-volume, low-complexity tests, the exact tests hit hardest by PAMA cuts, got squeezed the fastest, while labs that diversified into specialized, harder-to-replicate testing had more pricing room to work with. Pattern 3. Underestimating compliance overhead. Between CLIA inspections, proficiency testing requirements, and constantly shifting billing codes, a lab that skimps on quality and compliance staff to save money in year 1 often ends up facing an audit, a payer contract termination, or a certification issue that costs far more than the staffing it tried to avoid. What you actually walk away with. Scenario 1. A modest, independent lab, around $250,000 invested, running standard chemistry and hematology panels for a handful of local physician practices. Realistic annual revenue in the $700,000 to $1 million range, with reimbursement pressure keeping net margins in the 5 to 10% range. In a good year, call it $40,000 to $100,000 in real annual profit, and real risk of that shrinking further with each PAMA cycle. Scenario 2. You specialize. A lab focused on higher complexity, harder to commoditize testing genetic panels. Specialized pathology faces less direct price competition from the giants, and can realistically push net margins toward 15 to 20%. At $2 to $3 million in annual revenue, that's $300,000 to $600,000 in owner profit. the point where this becomes a genuinely defensible business rather than a shrinking one. So if you get into diagnostic testing, remember the real rule of this business. Your price isn't yours to set, and it tends to fall a little more every year regardless of how well you run things. Survive on volume, specialize away from the most commoditized tests, and never confuse a big valuation for a working business model. Theranos had one and not the other.